Welcome to Housing Developments.
I'm Jim Tobin.
And I'm Paul Lopez.
Paul, how are you?
I'm doing well,
Here
man.
we are in the middle of December. Finally, the DC weather has turned cold, which is always nice.
Yep.
And as you can all tell, sitting with us in studio today is our dear friend and colleague, Dr. Robert Dietz, NAHB's Chief Economist. Rob, welcome.
Good to join you guys.
Yeah, good to be here.
DRD, yeah, nice.
Well, before we get going, obviously there's a lot going on in the economic world, but I did want to say before we start, we'll say it again, but I wish you all happiest of holidays and Happy New Year
as well.
Which probably leads us into Rob. What you told us a little while ago is maybe the Fed gave us an early Christmas present.
Ooh,
so
maybe a small one. Yeah. I mean, after the fall, where we were definitely hearing a lot of hawkish commentary, inflation could stir back up again. We'll potentially raise rates again. It seems pretty clear after the December meeting, the Fed is now done raising rates.
Right.
They will continue to engage in quantitative tightening, which means reducing their holdings of mortgage-backed securities. That'll keep the spread between the 30-year fixed-rate mortgage and the 10-year Treasury rate at about 300 basis points. But here's the big news. They produced a set of economic projections for 2024.
This is the big one.
Yeah, we had in our forecast 2 rate cuts, one in the third quarter, one in the fourth quarter next year. The Fed went further. They're saying 3 rate cuts next year. So the soft landing, provided we ignore the economic damage that happened in 2022.
Yeah.
But the soft landing looks like it's in view. Now, what does this mean for builders? It means by the end of next year, we're probably looking at mortgage interest rates somewhere between 6 1/3 and 6.5%.
But the impact was immediate, right?
Oh, yeah.
I mean, same day, the bond market dropped and life, looked glorious to us, especially.
stock market rallied. Yeah.
The 10-year Treasury rate, which if we remember back at Halloween was at 5%, is now near 3.9. That is a huge 100 basis point move. And what's happened is basically investors are saying this is probably the top of the rate market. If you wanted to lock in on some riskless bonds at high rates, you don't want to be the last one in line to buy them. So they're buying them. And as they buy them, those rates are going down. So we still have some long-term issues. The federal government deficit is something I think we're going to be dealing with from a policy perspective in the next 2 to 3 years. But yeah, it sure looks like rates peaked in the fall. We're headed lower. And that's good news for single-family construction next year.
I can't believe I'm asking this, but I'm going to ask it anyway.
Okay.
Like, are you worried now that towards not so much 24 but 25 that the housing market will get a little too hot?
In segments, right?
Yeah.
If the concern is thinking about our traditional supply side limiting factors, that we're going to see a run up in lumber prices. That's possible. Lumber prices right now are below $400 per thousand board feet. They're pretty close to where they were pre-COVID.
Yeah.
So as the demand for remodeling and single family construction continues, we could see lumber prices go up. Lot supplies. We know that the cost of financing for both building and development right now is elevated. That means lot supplies are likely to go lower in the second half of 24. These are generally good problems to have because it means demand is getting priced back in. The big challenge for the industry is how do we provide particularly that entry-level construction? And that's where the advocacy elements, both at the national level and particularly at our local association level, to work on issues like impact fees, permit fees, zoning reforms. Membership's really going to matter in kind of an upward draft type market.
So talk a little bit about that inflationary pressures that Paul just highlighted. Inflation's still above 2%, right? Yep. Obviously the Fed must have some comfort that we're in a new normal of 3 or 3.5, that maybe 2's not, but we're headed there, but we don't have to wait till we get there. But if supply chains are tight, if home prices stay high because supply is not on the market, demand increases because of these lower rates, aren't we afraid that the shelter component of inflation, which is already an outsized portion of it, could that trigger another round of inflationary pressures on the Fed?
Yes. So in the short run, I think the Fed believes that the real-time data on things like rents are moving lower. So the expectation is that CPI, which is at like 3.1% right now, is going to move closer to 2 in the coming months. Their 3 rate cuts for 24 is based on that assumption. But you're exactly right. If lumber costs go up, and that means construction costs are higher, we're short of inventory. So as demand comes back in, demand's going to return faster than we can, as an industry, build homes. Yeah. Home prices are going to move higher. The homeownership costs will move higher. And that shelter inflation component, which is usually 30 to 40%, and right now, the most recent report was 70% of inflation, That's a problem with the Fed, but the Fed really can't work on the issues that are causing the limiting factors. So this is where our ask to the Fed has been, just talk about housing. We know you can't change zoning reforms, but you can use the bully pulpit to encourage local governments to make the right moves that we need so that we can get more housing supply on the market. And I think that's the challenge for 24.
So we immediately saw rates kind of now on the good side of 7, right? We're touching 6.9 or what have you.
Yeah, this morning.
At what point do you think the rates will go drop enough so that it kind of releases that inventory that we know is out there, but people have been locked in at their 3% rates?
Yeah, I think if you look at the data right now, something like 80 to 90% of existing homeowners have mortgage rates that are below 6%.
Right.
So it does look like in the market right now that magic rate is about 6%. And I think we've learned too from bigger builders using mortgage rate buy downs that if you can get down into the high 5s, that's the magic number. So 2024, maybe we'll see a little bit less price discounting, a little bit use of some of these incentives and buy downs. But if it's going to be 2025 before we really start to see on a sustained basis a 6% type mortgage rate. So these are still rates that are going to be higher than what we saw in 2018, 2019.
Sure.
But we still have a housing deficit of 1.5 million homes, which is why we've been saying all year our medium run outlook for the industry is 2025 through 2030 looks like a really good runway for home building growth. We just got to make sure that we've got the right policies in place to facilitate it.
Here, I'm going to go back a minute. You obviously the Fed funds rate is moving down. Okay, fine, 3 rate cuts. But you talked about quantitative tightening. You always mentioned there's kind of those twin things that the Fed does. But for our listeners' purposes, rates are the easy one to understand. Rates go lower, everything goes lower.
Right.
You said with that spread. Talk a little bit about that. And does that end? Does the Fed stand up in the middle of next year and say, "Hey, we're done tightening"? Explain a little bit about that mortgage-backed security market for.
So one of the things the Fed did in the Great Recession, and particularly after COVID, was to go buy long-term bonds. So this is 10 and 30-year Treasury bonds, but it was also Fannie and Freddie bonds. So and the effect of that was you've got an additional really large buyer of those bonds. It pushed down long-term interest rates. The downside, the cost of that, they built up a balance sheet of $2.7 trillion
with a T.
With a T. Yeah, we'll have to use it on their balance sheet. And at some point, investors have to look and say, that is going to come back on the market, and it's a potential inflation risk. It's a nominal interest rate risk. So the idea was with quantitative tightening, they will roll off that balance sheet in an orderly manner. It's putting upward pressure on long-term interest rates because now you've got more supply of these bonds than say, a change in demand. But I think the goal here is the Fed's going to do this slowly. So it's going to be with us for the next 5 to 7 years.
Oh, wow. Okay.
They're not going to take the balance sheet down to 0 because they make progress on it so that the Fed is, as a regulatory agency, a government agency, less involved in the marketplace, which I think most builders, free market types would say that's a good thing.
Sure.
But it means then that spread between the 30-year fixed rate mortgage and the 10-year Treasury rate, which in the years after the Great Recession, we were used to it being 160 to 180 basis points. It's 300 basis points right now. So if you could magically make those bonds disappear, we wouldn't be looking at a 6.95% mortgage interest rate. We could be looking at 5.7.
Right.
Well, that's not going to happen. It's going to remain elevated. We do have in our forecast moving into 2025 it coming down slowly, but we've got it kind of leveling off at around 220, 210 basis points.
And it's fair to say that that's one of the tools in the depths of the Great Recession and after that, right? The Fed was almost shot all of its arrows in its quiver, right? And if the economy did turn sour, they had no room to lower rates any further because it was 0 or close to 0, right? And then same thing with they don't want to buy more mortgage bonds, right? So this enables the Fed to be more nimble in case we do run into some economic headwinds. Is that fair enough to say?
Yeah, it's kind of like adding arrows into their quiver. The cost in the short run, of course, then is higher mortgage rates. But we want the Fed to have a smaller balance sheet. We want this
long term, absolutely,
big government agency to kind of get out of the market. I think that's a good thing. It's just it's like anything else. As the liquidity is drained out of the system, it's going to result in higher nominal rates. But the good news is if the Fed is correct and they've sort of been behind the curve this whole way, inflation's going to move lower next year. As inflation moves lower, they can reduce the Fed funds rate because they want to maintain an inflation-adjusted, constant, restrictive rate.
Right.
In other words, the sort of
the flip.
Yeah, you think of this as like pressure on the brake, right? As the car slows down, you might ease off a little bit.
Right.
That's 2024 for the Fed. We're still slowing down, but they can ease the pressure.
Wow.
Okay, so I'll ask the question then again. What's the bad news? What do you see could trip us up, or even is the recovery going to be uniform across the country, or are you going to still see pockets of areas that are going to take a little bit longer to recover?
Yeah, the data, particularly if you look at the kind of pre-COVID and post-COVID data, suggests the places with the greatest long-run potential are the places we all know. It's the places where population is growing the fastest. So that's like the Southeast and the mountain states. There's certain pockets in the Midwest,
okay,
particularly as we see a reshoring of manufacturing activity. I think both political parties would like to see more semiconductor production, for example, in the United States. So we would expect that to continue.
Right.
The places where the headwinds are the greatest are going to be the highly regulated markets. So a market like, unfortunately, like San Francisco is a good example. It's just going to be more difficult to build there and build that kind of economic momentum.
Right.
What we're worried about, just in terms of interest rate policy, is the federal government's deficit. You know, we talked about it, but it hadn't been really kind of a prime policy issue for the last 10 to 15 years.
Right.
Looking forward, we're only about 7 years away from Social Security and Medicare.
Right.
Reaching not a breaking point, but a point where something has to be done in terms of cut spending, raise taxes. So we've got to watch the federal deficit, because if that deficit grows as a share of the economy, long-term nominal interest rates, including mortgage rates, will move higher.
Yeah.
All right. Well, I think that's a good segue into our next piece, which is the federal government.
Yeah.
We actually had some pretty good news.
Yeah, it's a couple
on that front
things,
too, right?
Yeah, I mean, I think Rob talked about. It's up to policymakers to step in and at some point do something. The good news is we don't have a government shutdown. We don't have a lapse in the national flood insurance policy. We will fight these fights again in the new year, and in late January and early February is when the Hill gets their act together to keep the government funded.
Right.
Good. Okay.
All good.
In fact, today is the House is getting ready to get out of Dodge for the remainder of the holiday season. Senate should follow suit. And that still leaves a little hold with Ukraine funding, Israel fund, a lot of the war in the Middle East, that kind of, so there's still a lot of unanswered questions. In Congress, you've heard me say this before, they do one thing really well, and that's kicking the can down the road. So we're kicking into 2024, but nonetheless, official Washington is getting ready to wind down.
But yeah, you're right. We did have some big wins, right? HR 5473.
Yeah, easy for you to say, right? It doesn't roll off the tongue as much as you think. A nice win for Lake Colson, the government affairs team. That was, the House passed a bill by unanimous consent. So it's the highest honor you can have when everybody says yes. But a bill that would extend the currently expired sunset on FEMA disaster programs, which they would allow state and local code jurisdictions to use the latest 2 published codes as well as local amendments in order to qualify for disaster assistance. Really important for code cycles in the states, really important for affordability, really important for just states' rights and how codes are developed in America. So great win there. Yeah. Really hopeful we can get that over the goal line in the United States Senate, especially with the unanimous vote. This should be something we're hopeful we can tuck into a larger piece of legislation. We talked a little bit about some of the bigger items that have to come up in the first quarter of the year. Right. And then another one, the Workforce Opportunity and Innovation Act, WIOA, the big workforce authorization bill. A bill has been introduced to reauthorize that program. Really important for us and HBI and all of our workforce partners out there. Yeah. But what it included, importantly, is a 5-year extension of the Job Corps program.
Finally, some good news there, right?
This is the same Republican majority that's trying to cut it by 1.7 billion. Cut 1.7 billion, which guts the program.
That's right.
So there's a little reaffirmation, and I think it really speaks to our members activating as a grassroots network on the Job Corps funding to prove to their members of Congress this is an extraordinary, valuable program. Because as Rob said, this is one of those areas I always thought eliminating the Job Corps program is an unforced error, which is where government's getting in the way of solving the labor crisis, which is another inflationary pressure on home housing affordability.
Yeah. Right.
So good wins for, the government affairs team has been working, nonstop on this for months.
100%.
So nice way to kind of put a bow on the end of the year with some things that I think that have real policy meaning to our members back home.
No, absolutely. And speaking of putting a bow on it, I mean, this is our last podcast for the year, right?
The podcast of the year. Glad we have Rob in town with us,
right.
And to give us some good news.
That's right. And then on a high, baby.
Yeah, that's right. That's right. Yeah, and so we'll be back after the first of the year with another outlook. We'll have a better feeling we'll be in 2024, the pivot year, and as Rob says,
growth for single family home building next year. Absolutely,
that's awesome.
Wow,
and single family home building lower than last year or higher this year on
2022 and 2023 were down years.
Down years. Yep.
24 and 25 look like good years. Grow our way back to about 1.1 million single family starts.
That's awesome.
Call your shot right now. At the end of 2024, what are we at?
We will be looking at about 950,000 single family homes.
All right.
So
you heard this first there, people.
That's right.
Come up in 12 months.
And where are now I'm going to pin you. Where are mortgage rates in a year from now?
I think right around 6.4% by the end of the year. So that would be another 60 basis points.
Wow.
We've got a conservative forecast for both single family construction and rates, but I think they're both headed in the right direction.
Nice.
All right.
Awesome.
Well, guys,
happy holidays.
Happy
Merry
holidays.
Christmas.
Love you guys.
Yeah. All right, yeah. Be good.
all right.
So until next year, happy holidays and Merry Christmas to all of our listeners and all of our watchers. Until then,
I'm Paul Lopez.
I'm Jim Tobin. That's Rob Dietz.
That's right.
Warehousing Developments. Bye.
Bye now.